On today's episode, we are going to take a look at Intel Corporation. They just reported earnings, so let's get started. Alright, so first, let's start off by looking at this company's stock performance. Right now, the company is down 6% after reported earnings. So they reported earnings today, April 23rd, 2020, for their quarter one results. So right now, the stock is sitting at $55.50, and this company had an all-time highs of around $68. So $68 to that $55.50 where it's sitting right now gives this company 17% below its all-time highs, which I think is pretty crazy. So in today's episode, we're gonna do a few things. First, we're gonna take a look at the earnings results. Then we're gonna take a look at a few articles. Next, we're gonna take a look at the information they provided to us and take a look at their income statement, balance sheet, and cash flow statement. And finally, I'm just gonna end up giving my thoughts and my opinion on this company. Remember guys, I am not a financial advisor, so all these are just my thoughts and should not be taken as recommendations. All right, so now let's take a look at the earnings results. But actually, before we get there, guys, don't forget to subscribe, hit the thumbs up, and touch that bell. It helps the small channel out so much, and I truly appreciate the amount of growth I have seen in just the past few weeks. And also, let me know in the comments, are you guys excited right now to see that drop? Are you guys gonna start picking up some shares of Intel? Definitely let me know in the comments right now. So share your thoughts. So quarter one non-GAAP earnings per share were $1.45, which beat by 18 cents. GAAP earnings per share were $1.31, which beat by 11 cents. Total revenue for this quarter was $19.83 billion, and that beat by $1.17 billion. That's a huge beat, and that's 23% up compared to the same time last year. And one thing to take a note, guys, is right now, a lot of companies are either beating the estimates by high numbers or beating them by ridiculously low number, or missing them by ridiculously low number. And it just shows you how analysts, this is a whole new ballgame for anybody. Analysts are far off their target points. And this shows you how this whole pandemic has taken such a huge hit and no one really knows what's gonna happen. All right, so here we are still in seekingalpha.com. The article title is Intel Lower After Soft Earnings Per Share Outlook, and this was by Brandy Bentz. I've highlighted all the key points that I found important, and it was pretty much the whole article. So here we see that revenue was a huge beat for quarter one, and it was primarily driven by two things. The first thing was driven by the strong demand in data centers, and this is obviously right, all the clouding servers have increased their capacity and have increased demand for their servers, so they're buying more products. That drives that data center to go up. The second is coronavirus related work from home component. Obviously right now more people are working from home, more students, more kids are studying from home, so everybody here needs a laptop. In the data center group, revenue was up 43% compared to the same time last year to $7 billion. That's over 1/3 of the total revenue, right? What was the total revenue for this company? It was $19 billion, right? About 20 billion. So it was a little bit over 1/3 of the revenue came from data center group. And it's pretty crazy to see that up 43% compared to the same time last year, which included a 53% increase in cloud service provider revenue. Next, we also saw growth in the PC-centric business. It grew 14% to about $9.8 billion, and this was pretty much with notebooks or laptops posting a 22% year-to-year unit growth. This company also gave us guidance for quarter two. For quarter two, they expect revenue of $18.5 billion in revenue, where estimates are $18.1 billion. So they are expecting more than what analysts are expecting. And they're expecting $1.10 of earnings per share. The expected is $1.17. Next thing, Intel is not providing a full year outlook due to the coronavirus uncertainties. And I think I see a lot of people complaining about this, but we don't really know how much longer this coronavirus is going to affect the overall market. So I think it's pretty smart for them not to give us a full year outlook. They can kind of understand how quarter two will do, but there's so many uncertainties to even give us anything for quarter three and quarter four. So this next article just mentions that Apple is preparing its own chips for their MacBooks and all their Mac products. And this is obviously a big deal because, one, if Apple creates new chips, then it's gonna add another competitor into this market. And right now we already have some big companies. We have AMD, now we have Intel. Now we're gonna have Apple, and Apple is a company with so much cash, and it'll be able to have so much influence, right? They have the iPhones, they have iPads, and they have the iMacs, where they can just force those chips onto their systems. So obviously that is bad news for Intel. And the second thing, Intel is a big provider of MacBooks, providing their chips to Mac products, mainly their MacBooks. So they would also end up losing a customer there. So it would not, if they would, competition would increase, and they would also lose a customer for sure, for certain. But I can see why a lot of people are kind of fearful with Apple entering this market. All right, so next we want to take a look at this slideshow. This slideshow comes from the presentation that Intel gave to us during their earnings, and it's titled 2020 Headwinds and Tailwinds, and it's pretty much just telling us the actions they're taking and the type of market dynamics to expect. First, they say that data center demand was pretty strong, is pretty strong in this first half, so for Q1 and Q2. But they expect the second half, Q3 and Q4, to be a lot weaker due to enterprise and government's demand dropping. They also see strong Q1 notebook demand from work and learn from home, but they see this to offset later on, especially with the contraction of global GDP. So pretty much, right, more people are going to be losing jobs. So once everybody has their work laptop and has their learning from home laptop, there's no real reasons for your everyday American to go and purchase a new laptop, right? After that, demand is also going to drop. Next, on actions taken, the two things I mentioned already. First, they have raised a $10.3 billion in new debt, and they also suspended share buybacks, which I think is pretty smart on their end. All right, so next, let's take a look at this company's overall summary. We're going to take a look at their income statement, at their balance sheet, and their cash flow statement. But before that, I pretty much just wanted to break down how this company's revenue is truly divided. So remember, this company for Q1 made $19.8 billion. Out of that $19.8 billion, this company is divided into a few sectors. There's three items that pretty much make up 90% of this company's total revenue. So the first one we're going to talk about is PC centric, and this is pretty much the revenue sector that hits all the laptops, all the desktops, and any single CPU that you purchase. And this makes up $99.8 billion out of that $19.8 billion that it did in total revenue. So close, not yet, but close to half of the total revenue comes from this sector. And this sector was actually up 14%. But again, we mentioned that the main reasons were more people were buying laptops right now because of people staying home, and kids needing to learn from home. Next, we have DCG. DCG is Data Centric Group. And this is where all the chips for data center is set. So in data centers, you have like your cloud servers, and you have all your other servers here. This made up $7 billion of that $19.8 billion. And this was up 43% compared to the same time last year. The third biggest is NSG, and this is kind of a new sector that Intel has grown and that started. I think it's probably not even 2 years old, but it's already the number 3, and it made $1.3 billion this year. So we can see, right, almost I gotta say more than 85% pretty much just comes from two departments, the PC centric and the data center group. And we can see why kind of having a new competitor, the Apple chip that I talked about in a previous article, can be very scary for a company that pretty much most of the revenue comes from chips. But anyways, the memory group is made up of $1.3 billion, and it was up 46% compared to the same time last year. All right, so now we're going to take a look at this company's income statement. This is going to go pretty quick because we pretty much covered a lot of the stuff in the income statement. But first, again, just reiterate, revenue here for this quarter was $19.8 billion compared to $16.1 billion same time last year. So we see that nice increase in total net revenue compared to just a year ago. And usually for technology companies like this, especially a semiconductor company, one of the most important things is this company needs to make sure its technology is always up to date and they're always improving and innovating. And one of the best ways to kind of see is to see their expenses in research and development. Research and development is pretty much just what they're using to pay their engineers to make sure their products are up to date. Same time last year, this company paid $3.3 billion. This year it paid $3.275 billion. So a small decrease, but not much. Again, I like to see this. I would be pretty scared if I saw a huge decline in research and development. And to be honest, this is one of the few expenses that I don't mind if it jumps, because if it jumps, I know they have more engineers. Obviously, just because they have more engineers doesn't mean much, but just to know that the chances of more minds thinking and more work being done can really help this company go to higher heights. And the only other thing I want to take a look here in their income statement is their diluted shares. Last year, they had about 4.5 billion shares. Right now they have about 4.3, so they have been buying a nice amount of shares. Oh, there's actually one more thing I have highlighted, and remaining dollars authorized for buyback program. Right now this company had about $19.7 billion to use in buyback program, and even though they canceled this, at least they still have that money that they were going to allocate for that. Maybe they can allocate if things get pretty sketchy. So it's good to know that they stopped this, and this is that some money they had allocated for some other purpose, but now they can actually use it for any emergencies. All right, so next let's take a look at this company's balance sheet. And if you guys have been watching my channel, you guys know this is my favorite thing to really look at. And first, let's start off with just current investments. Total current investments, let's just start from the bottom and work our way up. Total current investments right now is sitting at $41.5 billion. Last year, it was $31.2 billion. So an increase of about $10 billion. One thing to take a note of, my bad, this is not for last year, this is for last quarter, so 3 months ago. So this is actually pretty good. It's indicating how this company has grown in just 3 months. The main reason this total current assets has increased by this much is because, right, we saw there was about a $10 billion loan that they took out, and obviously we're going to see that in the cash and cash equivalent sector. So let's just take a jump there to cash and cash equivalents. Right now this company has about $11.3 billion in cash at hand, and compared to just 3 months ago, it had 4.2. This is actually pretty much where all that growth in total current assets come from, and this is pretty much where all the growth from total current assets came from, right? It's about a $7 billion increase compared to just 3 months ago. The only other thing I want to take a look here in the current assets is inventories. And inventories, this right now, they have a little bit more inventory than they did just 3 months ago, but not by much, just about $500 million worth more of inventory. And this is just pretty much that's in work in process. So again, that's not really a red flag, but just something I wanted to stay out there. Next, let's take a look at this company's total assets. This company's total asset right now is sitting at $147.7 billion compared to 136.5 just 3 months ago. So that's about an increase of $11 billion. Most of it coming from that total current assets. That total current assets increased by about 10 billion. So most of it comes from there. And the other comes from a little bit here and there. Nothing really to really take a look at that throws a red flag. It's just a little growth here and a little decline here that ended up being that extra 1 billion coming from, and then the other 10 billion coming from that extra cash and total current assets. All right, so next let's take a look at this company's current liabilities. Let's just start off with short-term debt. This company, actually there's no red flags here. I don't even know why I have short-term debt highlighted, but short-term debt is pretty much the same compared to just 3 months ago. That's perfectly fine. That means this company has no crazy, nothing. If it was able to pay off, is that just 3 months ago, be able to pay it off now. So nothing there really freaks me out. Then let's take a look at total current liabilities. Total current liabilities grew by about $1.5 billion. So 3 months ago, it was at 22.3 billion. Right now it's at 23.9. So about 1.6. Again, in total current liabilities, I see a little growth here and there, but nothing that really stands out to me. So nothing worth mentioning there. Next, this company's total debt has increased, and obviously we saw this company took a $10.8 billion loan. So just 3 months ago, this company had $25.3 billion in total debt. Now it has $36.5 billion. So that was that 10.8 right there. All right, so next let's take a look at this company's cash flow statement. So in their cash flow statements, there's 3 ways they make money. So the first one, like I said, is net cash flow provided by operating activities. And this is this is the cash flow it gets from its everyday activities. So pretty much from doing business. So this grew by about $1 billion compared to the same time last year. And that's actually to be expected, right? This company actually made about $4 billion more in revenue compared to the same time last year. There's nothing really in here that throws a red flag. The second is net cash used from investing activities. And just like you and I, companies use cash to invest in different types of assets. And sometimes those assets go up, sometimes those assets go down. Obviously, we've been in a market where assets have pretty much dropped a bit. So here we see about a 1 billion drop in their assets. And again, there's nothing really to throw me a red flag. The one I really wanted to take a look at is net cash flow provided by financing activities. So this is cash flow that's shown after they pay dividends, if they buy back any shares, and if they take off any debt. The 2 ones I wanted to talk about are 2 I mentioned before. First is the issuance of long-term debt. So this company did take out a new debt, and we can see it right here, a $10.2 billion debt taken out this quarter. The second one I wanted to talk about was the repurchase of common stock. In this quarter, this company spent $4.2 billion in purchasing common stock. And this is, I find this a good thing to see, because now this company has halted common stock repurchase. So that means that this company, if next quarter, is not going to end up using $4.2 billion in cash to buy new shares. It probably wasn't going to use $4.2 billion, but now it's going to have extra cash in its pockets just in case things go bad. And that's again, I think that's pretty much all I wanted to talk about from this company's cash flow statement. All right, so now finally we are in this company in Seeking Alpha. Wanted to take a look at the growth revenue this company is expected to make. For December 2020, this company is expected to make $71.66 billion of total revenue. For December 2021, this company is expected to make $73.95 billion. So we see a growth of about $2.2 billion in revenue from 2021 to 2020. So that's pretty good. This is telling me this is a growth company still. And I think it's pretty impressive that this company can still see that type of growth. Now, my thoughts. So this is completely my thoughts and not a recommendation for anybody. I can be 100% wrong, but this is how I value my company. So first, we're seeing that for 2021, this company is expected to make $4.69. $4.69 at the current price of 55. So we do 55.5 divided by 4.69 gives me a PE ratio of 11.83. 11.83 forward PE ratio for 2021, I think is pretty cheap for a technology company. Not just a technology company that has very high free cash flow, a technology company that has dividends, a technology company that has a strong buyback program, obviously not right now, and also a technology company that has plenty of cash right now and is able to survive this problem that's happening around the world. I think it'll be able to survive pretty easily. It's also a company that's in sectors that I enjoy being right now. The cloud sector, the data center and the cloud servers are the 2 biggest growing items right now in the tech company. And for this to be a main component to there, I am actually pretty happy with this forward PE ratio. As a disclaimer, I do have shares of Intel, but when I do my reports here, this is completely unbiased. I here just go with facts. I here go with believing that if I'm gonna purchase more shares of this company, it would be like a new entry position for me. So I come here with pretty much a blank eyes. And I want to say, I really like Intel Corporation, and I am thinking once my money for this week goes in, I will purchase a few more shares of Intel. So let me know, guys, are you interested in Intel Corporation right now? Do you guys still think it might be a bit too overpriced? Do you see this drop down as an overreaction? Let me know your thoughts of Intel in the comments. And like always, guys, don't forget to subscribe. Don't forget to hit the thumbs up and the bell. It helps the small channel out so much, and I truly appreciate it. Take care and have a good night.